I'm not a financial advisor. This is not financial advice. Please do your own research. First off, I'd like to thank my boy PJ for putting together the official Vinny G Markets introduction video. Thank you very much. Much love. Introduction video was crazy good. No way was I putting that together. So let's get right into it. I wanted to do a market recap today because it's a textbook example of everything I was talking about in yesterday's video. What did the market do today? We reached new record highs. Why did we reach new record highs? Let's take a look at our indicators. The 10-year Treasury, stable. Markets love that. The US dollar, down. Markets love that. Crude oil, up big time today. And what I say about crude oil, for any significant changes higher to the stock market, we needed a big push in crude oil, and boy, did we get it today. Up 5.5%. So let's pull these charts up. Let's look at the 10-year Treasury. We're at 1.25. That's no change from Friday of last week. 10-year stable. Markets love it. We're all good with that. No spike higher, so no red flags of any type of crash or anything significant going on. So let's go to the US dollar. That's one of the other reasons why I wanted to do a video today. The US dollar down about 0.5%. Pretty big. So why is the US dollar down? Because they're starting to push back on that tapering talk. Whether they're going to push back or not, who knows, because you can't trust what the Federal Reserve says. But Federal Reserve President, Dallas President, this creature called Robert Kaplan, came out on Friday, started pushing back on any type of tapering talk. Why? Due to the new Delta variant going on. So if that's the case and there's no tapering come September, the stock market's going to love that. The reason why is because that's more money, more liquidity to the markets. With that happening, the US dollar will continue to go down. And what we say, when the US dollar goes down, the stock market loves it. So that's our second indicator that's doing what we want today. And speaking of the C-word narrative to push any type of economic agenda, let's take a look at this article. I would have thought this would have been bigger news in the financial markets and just world markets in general. New Zealand was set to be the first advanced economy to hike interest rates. This is big news. We haven't raised interest rates in quite a while, and New Zealand was going to be that first country to do it. And what was the reason why they couldn't? You can't even make this stuff up. There was one, I repeat, one C-word case in all of New Zealand that put a stop to the interest rate hike. That's just, it's totally insane. I can't even fathom that. And why is that important to us in the United States? It's because the same central banks that run New Zealand, they work for the same, it's called the Bank of International Settlements. That's the same bank that runs the Federal Reserve. All these central banks work together. So let's actually go to the BIS website to show you all the banks that are ran by this entity, whatever you want to call it, the BIS. So BIS member central banks. Let's go over a list of all these countries that they have a stake in. So you have to understand, these banks, they control everything in all these countries. It's basically every major and even every non-major country in the world. So you have to understand, when you think we're competing against each other in the world, everything's all ran. This is what the New World Order is. They control everything. They have a central bank in all these countries. They work together. So what can be done in New Zealand could definitely be done in the United States, where they use a C-word narrative to push or take away any type of financial agenda they have. But that's why we keep a bullish view on these markets. Right now, they're still about inflating these assets. They still want to pump these markets. They are not done yet putting money, flooding liquidity into these markets. So we're not going to change our bullish views. You just saw it in New Zealand. A raise of interest rates would have hit the markets very hard. And a raise of interest rates in the United States, it would cripple our economy. The stock market would crash. It would, forget it, the hit that it would take. So we're going to take what they did in New Zealand, move it over to United States, and basically say, I really don't see any tapering happening because they're going to use this C-word narrative to stop any type of pullback of tapering. And if you have any question on what raising the interest rates does to an economy, or at least the United States economy, the last time we were raising interest rates was at the end of 2019. let's actually pull that chart up real quick. Let's take a look. December 17th. I'm sorry, it's 2018. Let's take a look. December 17th, 2018. What was going on? The Federal Reserve put together something called autopilot. Now, what was autopilot? It was supposed to be, I think, every quarter the Federal Reserve was going to raise interest rates. This was under President Trump at the time. So let's pull up that article, and you could see that the Federal Reserve had their plan to raise those interest rates. So while this was going on, President Trump hated it because he knew that this was going to crash the stock market and it would look bad on him. So he basically was pleading with them to not raise interest rates. They eventually did not raise interest rates and started lowering, and you could see that the stock market at the time started moving up until 2020, where it crashed back down. And while we have this up, let's just take a look. It's just funny how they shut the economy down. Even with shutting the economy down, look how much higher the stock market has gone since 2020. It's absolutely insane. It makes no sense. And it goes into the case of our economy is not good. They shut our economy down, and look what happened with the stock market anyway. It just went up. Again, totally insane. But that's why I'm here. I'm here to show you what to look for. And today was a textbook example. No, I'm not Nostradamus. I just know what to look for, and I'm giving that to you guys. It's the 10-year Treasury, needs to be stable. US dollar moving down, because then it's the more dollars it will take to buy these stocks. Stock prices go up. And of course, crude oil, which needs to go up, which again, what happened today. And if you notice, these three things that I'm talking about, you're not really going to hear this on CNBC, Bloomberg, Fox Business. They're not going to tell you about these things. They're going to tell you that the market's going up due to other things. If the market goes down, it's due to other things. They're not going to give you this formula, these indicators working simultaneously, and this is what's actually moving the market. What this is, 10-year Treasury, US dollar, crude oil, it's basically the subconscious of the stock market. That's how I look at it. You can't look at the actual market to see where the market is going to go for the future, and that's the reason why technical analysis don't really work. You have to look at the other driving factors that move the stock market. It's what's in the basement, the subconscious. The subconscious controls 95% of our brain. So it's the same thing with the stock market. These three things, along with the Federal Reserve balance sheet, and don't worry about that, the Federal Reserve balance sheet is going to continue to balloon. But these three things, the subconscious of the stock market, when they're working simultaneously together, which is exactly what happened today, we're just going to move higher. That's how it is. And the 10-year Treasury, again, that's going to tell us when things are going to change and we're going to start moving down, and then we could change our positions. But again, right now, another record high. We're going to continue our bullish view on the markets. If you have any questions about what a lot of this means, I'm going to go over in future videos, maybe give definitions. But to be honest, you don't even need to know what this stuff means. You just need to know what to look for, what numbers, the direction it's moving. It's like a wise man once said, some people can't read the sign that says toilet, doesn't mean they don't know how to use it. So I appreciate everybody who tuned in. If you continue to want somebody in your corner who's going to guide you through these markets and keep you on the right side of things, continue to tune in, because again, I make it my personal responsibility to keep you on the right side of this market. And I know my reputation is on the line with any information I put out there, so you know the information is always going to be good. So again, thank you for tuning in. Hulk smash that like button, subscribe, and let me leave you off with this. As always, the God of Abraham is real, and may he bless you.
Well, I think what we saw from the Fed last night, that Powell and the FOMC are just determined almost on autopilot to go through with another rate hike in December. My personal view is they'll probably do two more in 2019. The other thing, Martin, which I think was noteworthy, was the omission of any reference to the volatility or the kind of sharp downturn in equity markets through the month of October. And many people have interpreted that as further confirmation that Jerome Powell is very much data dependent, and if the economy is strong, inflation is rising, he's just going to soldier on with rate hikes without providing the financial markets, the stock market, with any kind of safety net. So once again, we seem to have Powell saying that he's not going to put in a so-called Bernanke put or a Yellen put. And if there is a Powell put, it's very far out of the money, Martin.
So here's the question: is that a good thing or bad thing? You know, because I mean, the stock market obviously is important to the person who appointed Powell, who's President Trump. You've got the 2020 elections coming up. Who knows what could happen between now and then? If the market tanks, we have a situation on our hands.
Well, that's right. The bottom line is, I think, and I've been thinking it most of the year, that this is a very different Fed, and the manner in which Powell is implementing monetary policy is that he is absolutely determined to, continue with the normalization of monetary policy, and I think that takes the federal funds rate up to, 3% by the middle of 2019, and I think the capital markets are now increasingly repricing for that. And that means, Martin, does it not, that effectively that's exactly what the market is doing at the moment. We're repricing assets right across the investment landscape in a recognition of a normalization of U.S. monetary policy, and particularly sharp rise in the front end of the market. Look where the 2-year Treasury note yield is, Martin. It's knocking on the door of 3%. Which is pretty extraordinary.
Still watching? Perfect. Click here to watch another great video from